I'm going to share now some lessons that I've learned and try to help people think through what's been going on lately. One is that what's happened is a huge jump in interest rates. And this huge jump in interest rates happened after a quarter century of very low and stable interest rates. And most of the people who are younger than I am, most of the people in their 30s and 40s and 50s whose career existed only during low and stable interest rates, weren't trained and wouldn't know necessarily how to manage through the present environment. Of course, there's a lot of very capable people and a lot of well-managed banks, I imagine, but in general, the problem was this inflection point from very long period of very low and stable interest rates into much higher and volatile interest rates. And that was compounded by a group of people who didn't understand and hadn't been trained to deal with these things. Now it's fun for pundits and it's natural for politicians to cast blame. And I'm sure there's plenty of blame to be cast. There are people that probably should have done better, both bank regulators as well as bank managements. And inevitably, if we look hard enough, I'm sure we'll find fraud and abuse. There was certainly plenty of fraud and abuse that accompanied the savings and loan crisis of the 1980s. But the savings and loan crisis of the 1980s wasn't caused by fraud and abuse. It was caused by a huge change in the interest rate environment and wiping out of the sort of mark-to-market net worth of all of the savings and loans. And so let's think about what we were looking at today. We've got many thousands of banks. Some of them are very large, systemically important banks that are too big to fail, really 4 of them, JP Morgan, Bank of America, Wells Fargo, and Citibank. And then, many regional banks, basically banks between $50 billion and $250 billion. And then, thousands of community banks, smaller banks, with varying degrees of sophistication in their investing approaches and their understanding of asset and liability management. And this huge jump in interest rates. Last year, 2022, the US aggregate bond index declined in value by 13% over the year, a negative 13% return for the US aggregate bond index. What's in the US bond index, the aggregate bond index? Well, there's treasury securities, and there's investment grade corporates, and there's asset-backed securities, and there's mortgage-backed securities, and they're all investment grade, all very high quality and all very, very liquid. Well, what's on a bank's balance sheet? Well, they invest in commercial loans and mortgage loans and consumer loans where they originate or sometimes purchase all of those loans, as well as treasury securities and other securities. It's not hard to imagine that the lower quality, less liquid portfolio of a typical bank on a mark-to-market basis suffered as much or more than the decline in the US aggregate bond index, which was 13% last year. So if your typical bank had a 10, 15% decline in the value or more, or 20% decline in the value of its aggregate assets, how does that compare to its equity? Well, banks have somewhere between 5 and 10% equity. Almost all banks, I think, have more than 5% in common equity, although they didn't in 2007. But the regulations were tightened, and banks tend to have between 5 and 10%. If you have 5% equity, you're 20 times levered. If you have 10% equity, you're 10 times levered. I just looked up JP Morgan at year end. They were reporting that their common equity was 7% of their assets. Well, if it's reasonable to assume that most banks had a 10 or 15% decline in the value of their assets, and they have 7, 8, even 10% common equity, if that's the first loss position, then on a mark-to-market basis, that equity is probably not there anymore. Now, I don't want to alarm you. Many banks hedge. Many banks are probably in fine condition. And more to the point, nobody is going to liquidate all of their assets to repay all of their depositors. That's why we have a lender of last resort. That's why we have a Federal Reserve. And that allows banks to continue operating regardless of what their mark-to-market looks like on a book value basis. You could say all of their treasury securities are money good. Probably most of their loans are money good, and they probably are continuing to earn positive net interest income. There's no reason for a bank to liquidate just because on a temporary basis, in a theoretical analysis, their mark-to-market is negative equity. The Freddie Mac and Fannie Mae operated for decades with such a thin slice of capital that they were regularly going back and forth between having positive and negative equity on a mark-to-market basis. But in order to run that kind of fractional reserve banking, you need a lender of last resort. And here I will make a suggestion for reading. It's a great book published by Bob Brunner called 1907, which explored the banking panic of that year that was, in the event, solved by the lender of last resort, JP Morgan. Not JP Morgan the bank, but JP Morgan the person. And we learned from that and many other prior similar episodes that the stability of the banking system was too important to be left to one individual, and that was the impetus for several years later the creation of the Federal Reserve Bank, our lender of last resort. And we need a lender of last resort. It's important that we have a lender of last resort. And fortunately, that lender of last resort has stabilized the system now. Today, bank stocks appreciated across the board. One of the most troubling banks, First Republic, had at one point at least a 50% increase in its stock price. The VIX has declined, and all of this is because the regulators are fed. The lender of last resort has stepped in to provide liquidity. Our Treasury Secretary Janet Yellen, I think it was earlier this morning, pretty much announced that deposit insurance would be extended to all banks. She can't technically say that because only Congress can do that, but she came as close to the line as she possibly could to let people know that depositors were not going to take losses across the system, and that's as it should be. Now, there are going to be people who complain and demand that we have depositors at risk and that this is the end of capitalism, et cetera, et cetera. But I think that's not helpful. And the lender of last resort has to do what it has been doing in order to stabilize the financial system, which thankfully appears to be the case today. And I want to just provide some thoughts on, there's just trade-offs. There's this problem wasn't caused by fraud or avarice or awful greedy bankers, although I'm sure all of that is somewhere within the system, and if anybody broke laws, they should probably be held accountable, and if there were particularly incompetent regulators, perhaps their they ought to be demoted. This, they're public employees; they're not going to be fired, and that's all fine. But that's really not the problem. The problem was this huge shift in the interest rate environment, and it was inevitable that this was going to happen, even in well-run institutions. And the fixes that everybody's going to suggest really are just trade-offs. For instance, we could clamp down and be much tighter on our regulation of banks and have them have 20% equity capital instead of 7% equity capital. They would earn much lower returns on their equity. There would be reduced bank lending, and an awful lot of the credit intermediation in our economy would move out of the banks into the shadow banking system, into private credit. And then we would have made the banks very safe. There would never be any runs, or very few runs in the banking system, but all of those runs and all of that, all those problems would move outside of the banking system, and that's not what we want. We could enforce losses on depositors, but if we enforce losses on depositors for community banks and regional banks, but not for the systemically important great big four banks, then all of the deposits are going to flow out of community banks and regional banks and into the big four, too big to fail banks. And I don't think we're ready, really, or what we want is to have no more community banks and regional banks. I could go on, but the point I'm trying to make is that there are just trade-offs. There are no obvious, easy fixes that if we had just done what this politician or that pundit suggested, we could fix and eliminate these problems. So I'll leave you with that. And thank you for spending a couple of minutes with me.